Aloha, everybody. We are Rhetorical Capital Investments. My name is Zasha Smith, along with my partners, Chris and Harmony Borden. We're here to talk to you today about the diversification lie, what most portfolios get dead wrong. So, most people think that they're diversified, but they're really not. If you think about it, in the last few years, especially in 2022, portfolios that look diversified still dropped about 30%. And even for me, being heavily invested into real estate, doing fix and flips prior, I started in 2019. And then in 2022, once the market took a shift, I started diversifying into other asset classes and even other types of real estate in the equity market. So today we're going to walk you through how smart investors structure real diversification using both public and private assets, including what we're doing inside of our fund. And just a quick note, this presentation is for educational purposes only. Rhetorical Capital Investments is not a registered investment advisor, broker, dealer. So all investments carry risk, and we heavily advise you to reach out to your own legal team, your own legal counsel before making any investment decisions.
Thank you. So most investors believe that owning more investments means they're safer, but if all of those assets behave the same, they're just more exposed.
Yeah, we're gonna kind of look and try to break down, give you kind of more background behind what we consider diversification. And obviously, we do a lot of investing in the real estate space, alternative markets, but we want to kind of break it down, like look at it from more of a holistic standpoint, because it's not, if you're just investing in real estate, you're still not diversified. Like, we want to be able to look at and give you as much information as we possibly can. From probably a lot of it is just like our experiences, some of the things that we felt that we did wrong and we're trying to get corrected, and some of the things that we felt we did right throughout the whole process. So our personal investment journey. So diversification isn't just about owning more things. It's owning things differently. There's going to be, like, if I just was completely, most investors, most people that I know, myself included, if I reverse time about 5 to 10 years ago, only invested in the equity market, and even in the equity market, we weren't not that invested. We had some mutual funds, some ETFs, but we still were not fully divested. Some of the ETFs we had were actually in the same general segment of the equity market, so even more, we weren't diversified. So again, we want to sort of break down and kind of give an understanding. So what we did is we kind of looked back and we pulled 3 separate portfolios, one that's like very concentrated into the equity markets, one that's still over diversified but still correlated to the market, and then one that's a bit more truly diversified. And as you can see, so there's 3 scenarios. Obviously, the red or pinkish color is overly concentrated in the equity market, so only in tech stocks, large caps. The large cap market, again, for those of you, I mean, obviously it's pretty obvious what a tech stock is. They're on the tech side, so you're talking Apple, IBM, Nvidia. They're all technical tech stocks. And then large cap is publicly traded companies that have a market capitalization of over $10 billion. So still the same companies that I just rambled off, but there's others outside of that, like Johnson & Johnson, 3M, Coca-Cola. Those are all considered large cap markets. Now, obviously, if you're overly saturated in just those markets, something happens into just, again, there is a lot of retail investors that are in the equity market, which does definitely have a large impact on the ebb and flow of the real estate market. I mean, not the real estate market, but the equity market. Donald Trump or Jerome Powell says one thing, and the market shifts up or down depending on what they say. So there's a lot of correlation to and segmentation to kind of the news and what goes on the global side of it. And then you start looking at trying to diversify down. Like, again, if someone's maybe over diversified, they're probably still heavily correlated to the equity market and not diversified into more alternative assets of sort of what we're talking about. But again, don't take it with a grain of salt, because I'm not saying just get into alternative assets. To me, true diversification has a large blended portfolio of both. And even in the equity market, even if you're invested in the equity market, you're still diversified between small cap, large cap, maybe some emerging market, maybe fixed income. And you're looking at trying to truly diversify your portfolio so it's not so dedicated and can get impacted by one segment of the market, which a lot of times you're not going to necessarily have control over.
Yeah. And so I think it's very important for you to kind of look over what types of investments you have and decide, and look into, okay, are they diversifiable or non-diversifiable risk? So imagine you have some money to invest, like buying a rental property or investing into other people's deals. When you invest, there's two main types of risks that you should know about. So when I talk about diversifiable risk, it's company specific or asset specific risk. So this is like when something goes wrong, it affects mostly one thing you're invested in, like one property. And for example, if you own a rental property and it has a leaky roof, that's a specific problem to that property. But if you own several properties or are invested in several different types of investments, this kind of risk can be reduced because it's not all affecting one property or one investment all at the same time. So if you have 3 rental houses, let's just say, if one roof has a leak, then it's a problem for that house, but the other 2 are going to be okay. And then there's non-diversifiable risk, which is systematic risk. So this is a bigger type of risk that affects lots of investments all at once. So like if there's a recession or changes in the interest rates, which we've all seen these past few years, when that happens, that can impact many different types of investments, even if you tried to spread out your money in different asset classes. So the interest rates go up and there's a recession, almost all investments across the board might lose value because the whole economy is affected. And so in this way, diversifiable risk is more about a specific problem, and you reduce it by spreading out your investments, while non-diversifiable risk is about big things that affects almost everything. And no matter how much you are invested or how much you spread out your money, it's going to affect all those areas. So understanding these risks will help investors decide how to balance their investments and try to protect their money, even when unexpected things happen in the economy or things that aren't totally out of our control.
Didn't you have like a situation where you got impacted on your particular portfolio by not necessarily diversifying or possibly not doing anything with it?
Yeah, so for me, I had all of my money when I thought I was investing while working my job. I had majority of my investments in a 401k at my company because they did a match, and I thought, okay, if I just put it here, I'll have enough to retire at the end of the day at whenever I choose to. But when I had moved from that job, quit my job, and went full on to real estate investing, I didn't even think about transferring over that 401k money into any other type of a retirement vehicle because I didn't really know much back then and I didn't really do my research. And then when other people started investing into my projects from their self-directed IRAs, I was like, wait a minute, don't I have money in some sort of retirement account? Like I kind of lost track. And that goes to show there's like several millions of retirement accounts or 401ks that just get forgotten about, And so it's easy to forget because I think a lot of people are in set it and forget it mode. They think, okay, I'll look back at that when I retire and I'll have all that money. But when I left the company, I had 107,000 in my retirement account. And then 2 years later, when I went to go look back at it and said, okay, I'm going to, people are using this self-directed IRA. I'm going to roll it over into that. It was down to like around 70,000. So just in that few years that I wasn't paying attention to it, it definitely went down because of the economy. And so not to say that all of this will happen to everyone, but it's just a reminder to keep in mind to keep track of your investments and always kind of look at it, because you never know if you're not keeping track, then you never know what it
Yep.
might, if it's an asset or a liability at that point.
I
That's like
think
a
a lot of
that's
people don't realize it too, right? You're told to do these things when you're growing up, and you go and you get your retirement plan, get good benefits, and then you never really think about it, because what education did you really get behind that? It was just, you did it because you were told to, and then you forgot that you even did it.
I mean, I think a good point to make is because I would assume it's you were still invested in some kind of mutual funds. That particular 401k was still investing, right?
Yeah.
And that's again,
And heavily conservative, because I told them, like, I plan to retire in this year, so I want to be as conservative as the layout is, or whatever they recommend the strategy for me retiring, when I'm 65. So it wasn't even in a um
aggressive.
aggressive type of retirement. It was just in a normal retirement fund. But
Yeah, and then obviously the option of diversifying away outside. Well, again, for me anyway. I mean, I'm not proponent of one way or the other strongly, but I am definitely a proponent. I think we all are a proponent of just diversifying in general, right? If some of that money was still sitting there and some of the money was out working in potentially alternative assets, you probably would have had a different story. Which
right.
I know we talk about your portfolio, and I know your portfolio today has a much different story. So
Right. And that's when I knew that I needed to diversify or get into other things. And that's why I bought rental properties, and then I started getting into bigger commercial real estate, and then passive investing as well, and getting into lending now. So I think it's just, you evolve once you start to realize, okay, my money could be working better in another area, or could be the reason why I like real estate. I still have money invested in the stock market, money invested in venture capital, kind of all over the place. But my main area that I invest in is real estate, because I understand it, for one, but for two, it's a physical asset. And I think when it comes to just thinking about diversifiable risk and non-diversifiable risk, it's just about investing in what you know and what you can understand, but what you can also keep track of and manage, right? Once you see the market shifting, the stock market usually is the one to react faster than real estate. Real estate, it still reacts to the market, but in a slower pace.
yeah,
Yeah. So it's not like owning 8 different tech ETFs isn't diversification. Like some would think. It's not like eating 8 different flavors of ice cream and calling it a balanced diet, although it
oh
depends on the
darn it,
day.
it's not. I
It
thought
depends
I
on
had
the
a
day. You just might
balanced
feel
diet.
like
I was
it is.
wrong this whole time. Oh my goodness. See, we learn something new every day. I literally thought eating 8 flavors of ice cream would be considered a balanced diet. So thank you for teaching me that, Harmony.
Nice try.
You never know what you learn. I'm gonna at least do 3 flavors of ice cream tonight, so I'll be semi-balanced diet. Um, uh, so one of the things, so even in I kind of talk about it a lot. I talk about the risk return ratio, and probably the correct way to talk about it. And if you listen to um, CNBC or any type of equity market news, Mad Money, they talk about a lot the risk premium, and that's probably how we should actually refer to it. And then I'll talk a little bit more about something called a cap M. But when we're looking at the risk premium, and I talk about it all the time, like we're looking at different assets and different classes of investment, and you should theoretically get a different return depending on the risk that you're taking on. So the risk premium is basically what is that expected return for the additional risk that I'm taking on. All of these examples are specifically in the equity market, just to give you a general idea of how it should work. I guess not how it should work, but how it typically works if I'm, again, just doing day trading or maybe long-term trading. So again, when I'm looking at a specific asset to invest in, there is associated risk with it. And the risk is they're all going to be different depending on the investment that you're undertaking. Obviously, I can just look at this real quick. Bonds, treasuries is going to be the lowest risk. Normally, the risk-free rate is based off of the 10-year treasury. So again, we're looking at that as if I put all my money in there, then I can kind of guarantee that that's going to be my return, depending on what the 10-year treasury was at the time I put my money. Now, again, there's still risk associated with that as well. Like, really understand when we talk about risk, there's the risk of missing out on an opportunity as well. So you're trying to actually balance all of that, which is not the easiest thing to do. That's why a lot of people hire financial advisors to kind of help them out in that realm. But understanding that there should be a premium the more risk you take on. And there is, again, there's market statistics out there that sort of tell you, based off of the risk that I'm taking, what should that premium be. And then understand that I think a good general rule of thumb is the higher the return, theoretically the higher the risk. Again, a clear example, if I'm looking at this, I'll just do bonds and small caps. So again, small caps are smaller capitalized companies, anywhere between 400 million capitalization up to 10. Well, actually, I think it's 2 billion capitalization. So that is considered small caps. So they're small, normally in infancy stages of their organization. Now, obviously, if they're in the infancy stage, there is a larger chance that they're going to blow up and you're going to get a gigantic return. But there's also a larger chance that they're going to fold and everything is going to go to the wayside and you lose all your money. So you're looking at that, and there's obviously associated risk there. So I should have a premium return for that risk. Conversely, the opposite, if I'm in bonds and treasuries, very, very low risk, but I'm going to get a significantly lower return. So the risk premium that I'm willing to take on for that lower risk is at 1% to 2% range. Now, again, the same thing would apply to alternative assets as well. So if I'm looking into just real estate, so I'm looking, and even in real estate, they're all different. But if I'm looking at just real estate to venture capital, real estate is going to be a lower volatility, lower risk in general than venture capital would be. So I'm going to demand a higher risk premium for venture capital than I would real estate. So just understand, we talk about it a lot, a risk return ratio. It's technically you can call it both. Risk premium, again, the premium that you would demand on the added risk that you're taking on. And looking at it from a different perspective. Now, there's another thing that I talked about earlier called CAPM. So it's capitalization. Now my mind just went blank. Capital asset pricing model. That's what it stands for. My mind went blank. But basically, I actually got the put the formula in here for you. It's a very ugly formula. Not a fan of calculating that, but let me just kind of break it down. Let me break it down into layman's terms. Basically, it's the risk-free rate. So RF is risk-free. So it's the risk-free rate minus the expected return divided by the beta, that's where it gets super ugly and confusing. The beta is basically what my risk-free rate is versus what the market risk is, which is, again, very complicated to go and calculate. But it basically is telling you that the risk that you're taking on should be compensated as much as possible. And then again, the cap-in does tell us that the market only rewards us for taking on systematic risk. There's no bonus return for taking risk that could be diversified away. So again, we're kind of talking about diversification. It doesn't necessarily make sense for you to have all your eggs in one basket just because the return premium is there. You want to be able to diversify away, because again, just because there's a return premium, it also means you're taking on more risk and the possibility of losing. So you want to be able to diversify between those different asset classes, between the different risk premium factors. And depending on where you're at in the stage of your life, you want to be able to kind of like Zasha sort of said it. Normally, you're going to be advised to do the opposite from what Zasha said, but she still had a plan. Her plan was she wanted to be more conservative, so she had more probably in money market bonds, treasuries, her investments, and less in the equity market. Typically when you're younger, you get more aggressive. When you're older, you start to get more conservative. But everyone has a different path. There's no right, wrong. This is not to say what Zasha's plan was wrong. That was her plan. Everybody's plan is going to be specific and tailored to them on what you guys are looking for, because there's tax implications as well in a lot of the things that we do. So again, we have to look at it on what's unique to us, but understand we still need to look at the risk premium associated with it, and sort of diversifying on that risk as well.
Yeah. So if you're getting hurt by risk, that better diversification could eliminate. That's just a sloppy portfolio design. Yeah, but this goes back to what I stand by earlier. Where do you get the education on your retirement, what it should and what you need to be doing at what age and all of that? I mean, I think it's different for everyone. I know Chris just kind of read it and knew it right away. That's just how he functions. And I had to wait for somebody to tell me you should be doing this. And I did that. And it still didn't do it that great because I already did it too late before I left my job. So I just wish there was more education out there. So I hope you guys are watching this.
Maybe kind of talk through, Harmony, how this would kind of tie back into. So what are some of the things that we could help the listener solve in the diversification?
Understanding where they should, how diverse and where.
Sorry, I'm specifically talking about from the fund side of things.
Well, specifically from the fund side, it's a comfortable spot for us because it's steady returns. Our fund is working every 6 months within our terms, and it's just comfortable.
Maybe take a step back and explain what our fund does.
Well, I guess like Zasha said earlier, right? It's backed by real estate, so it's tangible. It's something that you put your stuff in the stocks and you just watch it go up and down, deciding on what somebody wants to say out there in the world, and then it'll do its thing. And you're reliant on that. Where on this, we are mitigating a lot of that risk because of our relationships with the borrowers, the work that they do, how they do it, and it's something that we like to function in states where we know them and we can have boots on the ground to follow through the projects and whatnot. And then watching the market in those areas, understanding the market in those areas, the fluctuations of it, and investing in something that is going to be a win-win-win, meaning it's going to be a win for the borrower because they have the assets, there's equity in there, there's wiggle room for everybody to make a profit off of. And unless the world goes to, I guess, similar to
crap in a handbasket.
Yeah, I mean, I was trying to look for the
You're trying to find, nicer, more political.
So I mean, unless it does something like that, it's really hard for us to, at worst, not break even. I mean, and we look for the win-win, and there's enough wiggle room and things to where our borrowers are going to do what they need to do and stay on track as long as they're good on that and we're watching it closely. That's one big risk that's mitigated. And then we have our investors who are bringing in their capital and they get to win, and then we get to win. That's why I said it's a win-win-win because you have that tangible asset.
Yeah, so just for clarification, so what we do here at Retoro is typically first lien debt positions. So everything Harmony said wrapped up into debt. Again, looking at it from the perspective of it, the correlation, so very low correlation to the equity market. And again, as part of what you're trying to diversify your portfolio, you do not want it all to be correlated to one segment. And again, even in your equity market portfolio, you want that to be diversified away. Any good advisor will advise you to kind of diversify, look at maybe emerging markets as an opportunities, large caps, small caps, and then depending on where you're at in your investment horizon, kind of look at the money market side of things. But exposure to real estate, venture capital, all opportunities, private equity. So again, what we do is private placement, both on debt and equity, primarily debt, but also on equity.
Thank you. So diversification isn't about more stuff. It's about the right mix of risk premiums, cash flow, and correlation. That's what separates real wealth strategies from the guessing games.
So, what equity diversification looks like? Chris, bring up this Callan periodic table. So, I don't know about you, but this looks very overwhelming. But for a simple way to look at it, think of it as a chart or calendar that shows how different types of investments did over the years. It's a way to understand how they performed in different time periods, just like when you're in school and seeing your grades over the year, seeing how well you're doing in different projects. The Callan periodic table just shows you how different investments are doing. So the key things to understand when you're looking at this is that there's different types of investment. So like we talked about, we're going to try to bring it back and simplify it. So you could own investments like stocks, where you own parts of a company. You could own bonds, which are loans you give to companies or the government. Or you could own real estate. That means like buying properties or investing into properties. And each investment type has its own section on the chart. And then the years across is how many years it goes over. And then the color coding is just ranked from highest to lowest. And so as you can see in, let's just say 2010, the stock market might have been ranked first, but did they do that? Did they do that their best that year? Or did it change the next year? So for example, one example I like to use, especially lately in the past few years, real estate in 2020 obviously dropped and was the lowest. And even in 2022, once things started to pick back up in 2021 after COVID, in 2022, once the interest rate spiked, then that had a immense effect on real estate again. So that's just to go to show you each year, you could be at the top or the bottom, depending on what type of investment you are leveraged in. And so that's why it's key to diversify across many. And so for a new investor, this is a helpful tool, but because it shows you that no one investment is always the best. So we like real estate because it's a real tangible asset, but it's not to say it always performs the best over the course of time. Just like the stock market, the returns are positive, but it just depends on how you want to spread your money across different investments. So for me, like I mentioned, in 2022 is when the market really tanked. And as you can see, majority of the investment types all did bad. Like even cash was like at 1% returns. So there's a lot of ups and downs in different investments over the years. And so this is just to show you, to help you make smarter choices in what you do with your money in the future. And believing any one category is permanently better is a dangerous gamble. And so, like we mentioned, we're diversified into different assets, maybe some more than others, but we're always watching the market to see what it does and understanding how it affects each investment type differently.
Yeah, I think it's kind of important to point out too. So the graph here does, I mean, the table here does show real estate, but just point of clarification: this is all key indices within the equity market. So real estate meaning REITs, but again, the REITs do have a correlation to the real estate market, but it also has a larger correlation to the equity market. But again, the point, like Zasha said several times, is just that a lot of it is about diversifying. If I only had all my money in emerging markets, which back several years ago, I did have a decent amount in emerging markets. Probably around that time frame that it actually did good was the time I had majority of the money. But if I only had money, and then if I left it there and didn't diversify away from it, you can see I would have been taking a larger hit on our overall portfolio. But it's a lot of it is this understanding that you want to be able to really diversify into several different segments, and then change. I would say, like, Sasha was kind of saying this earlier, but no one's honestly going to care more about your money than you do. So really understanding what's going on with the market, what's going on just in general, and maybe making that first step, that first initial step to one, get yourself educated. Obviously, we got some people here listening in on this webinar, so that's great. Like that's part of that. That's part of the step getting there. But then just looking at it and start looking at diversifying your portfolio into different opportunities. Alternatives will be phenomenal. We can definitely help there. And there's a lot of great operators out there that can help there as well. But even if it's not that, just looking at within the equity market and look at, again, kind of listening on to what's going on in the market and then making moves periodically every year, every 2 years, really looking at your portfolio and making those adjustments.
Yeah. So what do we mean by alternative? It's not stocks or bonds or mutual funds. We're talking about real estate, private lending, private equity funds, and venture capital. I mean, these are things that we all are pretty diverse in those aspects. And then you want to make sure it's whether it's uncorrelated or correlated with moves differently, right, than the stock markets. And you want to make sure that you can try to provide a buffer in those volatile times. So it could be often more liquid, and it takes long-term discipline too. But you want to
Everything
make
does.
sure you want to make sure you avoid emotional investing mistakes, right? When things started to change, you've seen a lot of people, oh my gosh, I'm going to sell, and then later on they're like, oh my gosh, I wish I never sold, and things like that. So you want to try to remove the emotion as much as you can. But when you own private deals, the public, rush into it. You don't panic to sell. So definitely a move you want to look into alternative assets.
I'm going to talk about the Yale endowment model. It's basically an investment strategy that's created by David Swenson. Hopefully, I pronounced that correctly. I've heard of the model before. Never did I'm going to be honest, didn't do a whole bunch of research in it, but he was former chief investment officer at Yale University. So there has to be some validity there. Well, basically, he looked at, and you can Google it, and you can look up his portfolio mix. Over 50% of his portfolio was in alternative assets, and he did phenomenal in his investment strategy. There's not one investor out there that hasn't very well-known investor, even Warren Buffett, into alternative assets. They have it in our portfolio. It's something that should be included in everyone's portfolio, I believe. I wish it was something that was educated more. I mean, again, I would say right, wrong, or indifferent, most financial advisors do have a fiduciary responsibility to their investors. However, normally their compensation is tied directly into the amount of assets that they have under management, which, again, there's pros and cons there as well, because alternatively, the better they work and the harder they work for it, the more your portfolio theoretically should grow. The more your portfolio grows, the more they get compensated. However, there also will be remiss to kind of divulge some of the information on the alternative side of it. But the alternative side of it will typically have higher returns and you might not necessarily take on higher risk either. So it's really important to look at that as well. Like when you're looking at it, so you have private equity, venture capital, hedge funds, private real estate, private lending. Like there's a myriad of different investments and investment types that you can do in alternative assets, and understanding the risk profile that you have as well in alternative assets will kind of open your eyes, I think, a lot more to be able to look at, okay, if I can get so we had a comparison up with the risk premium and the money market and the bonds and the debt side of things, and there was a 1 to 2% risk premium because, again, you're taking on lower risk. It's the same thing with private debt. I mean, it's not going to be the exact same, but you're taking on a lower risk return profile. You're going to take on a significantly lower risk than you would on large caps, small caps, period. Now, over time, like if I went back to the last 15 years, large cap has just been phenomenal. I want to say large caps have been 15% if I take my average compounded annual return for, it's probably over 15%, it's just slightly over 15% for the last 15 years, which is a phenomenal return. Now, the now you have to then again look at historically over a longer period of time horizon, how well has it performed, and has there been times where it's dipped down? And yes, there obviously has been times where it's dipped down. If I take a longer period of time than that, and I just look at large caps, now it's probably down to a 9% return. Now, if I look at it from the alternative asset side, especially with like again correlation to what we do, and I can do that same return profile with a significantly less risk and give a potentially higher return, maybe not as high as the 15-year was in a large cap, but still a pretty high return, a 10 to 12% return on a lower risk premium than a lower risk profile than you would, and a significantly higher risk premium than you would get in the large caps. It kind of blows my mind that there's not more people doing it and not more people looking into it. And still not saying pull your money out of the equity market, but still, again, the proponent is look at diversifying some of your portfolio. We have actually a large portion of our portfolio. Our overall portfolio, it's probably close to 70% in real estate, but out of that 70%, it's probably somewhere between 60 and 70% in the debt side of things, where we're taking on a significantly lower risk profile, and the return profile is still higher. So the risk premium that we're getting on the investments that we're doing is absolutely phenomenal. So again, if Mr. David was doing it from Yale, chief investment officer from Yale, he has to know something. And I'm going to assume and I wish I knew about his investment profile earlier, because then earlier in my life that we could have kind of diversified away and not necessarily had the volatility of the markets. Again, we had a lot of money. Well, we had all of our money in the markets in 2008. We had the majority of our money in the markets in 2019 when it wasn't so hot as well. Actually, 2019 was hot. 2020 wasn't so hot. 2020, latter part of 2020 is when we started pulling our money out and started diversifying more into alternatives. So kind of taking that with, I wholeheartedly believe in what David says. So
the biggest institutions don't rely on public stocks to build wealth. They lean heavily on private deals. That's the strategy we're making available to individual investors through our fund.
Okay, kind of to end it all, well, not to end it all off, but one of the final things we kind of wanted to show you, just from a visual standpoint, it kind of goes back to what we're talking about. Again, looking at the diversity, the 60-40 portfolio is probably the most well-known portfolio out there. So 60 equity market, 40 is in money, some type of safer investment, money market, bonds, treasuries. That's your typical investment. So what this graph kind of shows us is different investment profiles. So you get your 60-40, your public market aggressive, and then your public private balance. The biggest difference, so these are average annual return versus the max downturn or max drawdown. So the maximum amount that you could lose within a given period. Now, obviously, I can quickly look at this and say, okay, having a public and private equity balance sort of makes the most sense. Just specific, it might not have the highest return, but you also don't have the highest down draw, right? If one particular year comes down, now if it's, I don't have the numbers. I wish I could hover over it to give you the numbers, but the public private balance is, if I had to guess by looking at this, is somewhere around 6.5, 7. And the public aggressive is probably somewhere around between 7 and 8, and then maybe obviously lower on the 60-40. I don't know exactly what the numbers are, but then the drawdown is in excess of 30% on the public market aggressive, and the drawdown is just slightly over 10%. So it looks like somewhere around 12% on the. So over the period of time, right? We're looking. This is average annual return. But if I'm looking at over the period of time, I'm going to overall make more on a well public balanced portfolio with both public and private offerings. So on the public side, meaning the equity market, on the private side, meaning private equity. Again, similar to what we do, private equity, private placement, private debt, venture capital. So again, just kind of looking at it, the whole basis of what we're trying to articulate here is just looking at diversifying your portfolio away from, again, on the opposite side, if you're only into alternative assets, we would caution you against that as well. Look at diversifying into some public markets. And well, looks like we got a question that just popped up, kind of threw me for a loop there, but I guess let's go through the question. You want to you're popping up the question, Arm. You want to go over the question?
Well, I don't think this was a question. This was just saying that headline grabs. So they feel like it's about to punch through some conventional wisdom. This was earlier and they're here for it. Diversification is often treated like gospel, but most people don't actually understand what they're diversifying or why. Looking forward to seeing whether this unpacks risk exposure over fragmentation or just lazy asset allocation dressed up as strategy. If this challenges the more funds equals more safety mindset, it's going to open some eyes. So they were just excited about this. We did have a question that came in by Tevin. You want to go ahead and answer this?
Do we have Chris wrap up first before we answer questions?
Yeah.
I feel wrapped because questions came up and threw my train of thought.
We're wrapped.
The basis line is diversification. We can jump into some of the questions. I know you had some stuff to go over, Zasha, but is having dividend stocks not diversification? No, it's not diversification because, again, dividend stocks, you're normally having, obviously you have repetitive dividends, but typically lower overall returns. You also, which I pointed out earlier, you also always have the risk of loss of opportunity, right? I can take all of my money, again, take this with somewhat of a grain of salt because it depends on where you're at in your stage of life. If I am at the tail end of my life and I just need some dividends to live and I'm only going to have 3 flavors of ice cream every day, I'm going to stay in and watch Golden Girls or whatever the heck we're going to do, you're probably okay. It depends on what stage of life everyone is in. But in a typical portfolio, when someone starts investing, we talked about our last webinar. Hopefully everyone's here is 11 years old and they're starting, because by the time they get Warren Buffett's age, they'll have $2.2 billion. And who does not want $2.2 billion? But yes, you want to be able to diversify because you're mitigating your opportunity loss if you're not diversified into more assets that could give you a higher rate of return. So there's always that opportunity and always that risk as well. People don't realize, if I have all my money in the bank, people say I'm safe, I don't have risks. If I have Dave Ramsey, I don't have risk. That's exactly where I should be. I would say that that's not true, but it depends on where you're at in your stage of life. If I'm younger and I want to build up a portfolio, if I want to get to that, again, it's looking at what your goal is and how do you see, what do you want your life to look like in the future, 5 years from now, 10 years from now, and have those goals and work towards those goals. If you don't have those goals, one of the things that Harmony and I do every single year is we sit down and we plot out our goals. What are our financial goals? What is it going to look like? What are our non-financial goals? We haven't done it yet. Hopefully one of these few weekends, we're going to have our kids sit down and do the same thing. You need those goals so you know exactly where you're going. If I'm just throwing all my money into a dividend diversification, then that's not diversified, and I'm just hoping I get dividends. So you need to have that goal, paint a picture of what you want your life to look like, and then make sure that your investment strategy aligns with that particular goal. There's not enough information there. Let's just go with yes. Oh, sorry, they're all primary markets. The reports that we got were all from the primary markets. Nothing on the secondary. Our investments are in the primary markets as well. We do. I'm not 100% sure where the question is coming from, but the equity markets, they're all primary markets. There's no secondary data there. On our debt side of it, we do first lien positions. We don't buy nothing off of the secondary. It's we originate the loans ourselves. We manage the asset as well while we're going through the loans. Again, I'm not 100% sure where the question was coming from, but hopefully that covers both aspects of the question. That was awesome. Okay, wrap us up, Zasha.
Well, thank you guys for joining. If you guys have any more questions, feel free to reach out to us. We are Rhetorical Capital Investments. You can go to partnerwithrci.com, scan these QR codes. And for joining us, we want to give you a free gift. You can take a 5-minute diversification quiz. If you scan that QR code, I've also put it in the chat as well, that will walk you through different where you're at and kind of get you thinking. I just took it, I think, a couple weeks ago and realized I was heavily invested in real estate, which is what my goal is right now. But in the upcoming years, I may want to diversify even more into other investment types. And what it does is, after you take this 5-minute quiz, it's really short. We will also send you a report on what different strategies you can utilize to be more diversified, or what suggestions that we give, and not only to do with real estate, but also in other sectors to help you, keep more of your money, keep more of your wealth, and be able to sustain the ups and downs of the market. So if you're looking to reduce risk, increase passive income, and sleep better at night, then definitely scan the QR code or reach out to us, partnerwithrci.com. You can book a call as well. But this is for educational purposes only. Consult your advisor or book a call with us and talk directly with us, because we'd love to help you in whatever situation you're at. Just kind of see how you can increase your cash flow and passive income.
That's awesome. I've had a blast. Thank you guys. Much mahalo, and thanks everybody for tuning in and listening live on our webinar.
Thank you.
Thank you. Ahui ho.
Ahui ho.